Jobless claims come in for the month at 861,000. So Tom's fondest hopes of a better number go by the board. Last week revised up to 848. So not only did we lose the 7 handle on jobless claims, they go up to 848,000 for last week and 861,000 for this week. So still a lot of people without work. I want to quickly mention a couple other numbers, and that is the Philadelphia Fed Business Outlook up to 23.1. The forecast was for a drop to 20, but last month it was 26.5. So it's hanging in there. It's just not great news. The employment index rises to 25.3 from 22.5. So good news in terms of some jobs. And then import prices were up 1.4%, much better than expected. And we're watching that because we have seen a big rise in petroleum prices. And with the dollar weakening, we have been importing inflation, and that may have an impact down the road. I just want to get back to one thing I want to mention before we go away here. In terms of the data today, particularly jobless claims, watch for a huge drop next week.
Why?
Because nobody in Texas, Kansas, North Dakota, or the South
but they'll have a paragraph that adjusts for that.
Are getting out to file for claims.
We have a stasis here. We've got a moving average convergence at just above 800,000. There's no question about it. What portion of that is what we all observe, which is restaurants, bars, that business flat on its back?
A lot of this is
600,000 delta, 800 to 200.
Yeah, it is going to be the service industries that have really done badly, and people have been laid off. And the question is, do they drop out of the labor force and stop looking for work? We saw some of that happen last month, and we'll see when we get the new numbers in 2 weeks whether or not that is the case. We're not going to see the Fed do anything. We got the minutes yesterday. They're a little more optimistic about the way the economy looks in the second half of the year, but until people get back to work, they're going to stay where they are.
Mike McKee, thanks so much. John, I got a little bit of movement in the real yield, but I'm going to call it stasis.
Yeah, not much. 129.90 on 10s. We don't move much off the back of this. Not the kind of upside surprise you want when claims drift higher. 861 on claims. The previous read, 848. But, Tom, the labour market's been so difficult to read. A read across from jobs across to the broader economy. Why? Because of the fiscal stimulus effort. Last year, the big dynamic that was really counterintuitive to begin with was just to see unemployment surge, but disposable incomes build, largely off the back of the fiscal stimulus plan. And I think Mike might agree with this as well. Claims the story for January. I mean, we had a lot of checks sent out to a lot of people, and that's why you probably don't see that stack up with what happened with retail sales yesterday as well.
Yeah, we're spending money that the government is giving us at this point, we being the people who are out of work, and that's probably going into staples much more than anything else. We did see some discretionary spending increase in January, but I wouldn't look for that to continue into February.
Mike, very quickly before we get to Nathan Sheets, we see adjustments to GDP. Atlanta Fed 9.x%. Ellen Zentner capitulates up to 7.5%. Do you look at that as a one-quarter statistic, or can you extrapolate forward better GDP numbers?
Well, I think everybody's extrapolating better forward GDP numbers as we get more people vaccinated and more people feel comfortable going out and spending money, and then maybe these service industries start to reopen. But I wouldn't take the Atlanta Fed number literally, because it's a snapshot in time, and they raised it by 4 percentage points yesterday after the strong retail sales numbers. But we'll get weaker data as we go through the rest of the quarter. I mean, nobody's building houses this month. This last week, there are no house construction underway in Texas, so that's going to impact the data.